I don't think silver's going back to 70. I think 72 will hold. It could go a little lower than that. I don't think it'll go much below 65, but the S&P goes up, gold and silver go up. They absolutely love it. I mean, we've had a 5% sell-off in the stock market, and gold's off 10%. Silver's off 33%. This was kind of my argument with Michael Oliver. Other than that, yeah, gold and silver are both in a bubble. The chances of gold not trending to $7,000 or higher is probably less than 20%. So Wall Street's got their percentages out of whack. I listed 18 stocks. 18 stocks with significant leverage if silver goes to 150 and stays there for at least 2 years. And I actually threw a couple of charts in there to show the kind of leverage that these things have at 150 silver, which I think where we're going. Now, where I'm leading up to here is the Iran war. And you can go all the way back to 2008 to 2020, manipulation of the markets, where the Fed is basically not allowed the free market to work, taking interest rates to zero when we're growing. Warren Buffett, he's all in cash. Jeremy Grantham, the king of the bubble, says that this is the worst bubble he's ever seen. Jim Rogers, Jeremy Grantham, Peter Schiff, Ray Dalio, those guys are basically saying, don't you guys see the fire? Everybody's blind. There's a fire burning, right? But everybody's ignoring those guys.
You mentioned how really Wall Street is not paying attention at the moment. It does seem like the stock market is starting to roll over, and I did want to get your perspective on just today, as we record this on Friday, March 13th, we did see silver down almost 4% here. So it seems like we're seeing the start of a pullback in the stock market, and certainly today, not that great of a day for precious metals. What do you think was the catalyst for this drop in gold and silver?
No, I've been saying this, that the most important chart for gold and silver is the S&P 500. The gold and silver absolutely love a positive S&P. The S&P goes up, gold and silver go up. They absolutely love it. I mean, you can go. They've been correlated quite strongly since February 24. Once gold became a bull market, gold loves a strong stock market. Sometimes it corrects even when the stock market is still going higher, but then it turns around and rips back up. It's like, oh, you guys are up there? Oh, here I come. Let me go join you guys, right? And you get an all-time high in gold. I mean, gold went up $3,500 in 2 years. So it was ripping higher. And so is the S&P. So they've been correlated.
Most investors ignore the subtle S&P correlation driving metals. As Don Durrett points out here, gold and silver's performance has closely tracked the S&P 500 since February 24th, yet headlines barely acknowledge this linkage, creating false narratives about metal weakness. A 4% drop in silver on March 13th signals a temporary pullback, not a trend reversal, highlighting how Wall Street often misreads market signals. Investors should watch the S&P for predictive insight rather than daily chatter. Next, Don Durrett discusses the mechanics behind these correlations and their portfolio implications.
Gold loves a strong stock market. It doesn't really like a weak one. And so we've had a 5% sell-off in the stock market, and gold's off 10%. No surprise. Silver's off 33%, but that was because in January, silver actually went bonkers. So it got overbought. And so it's basically going back to its mean. But it's still, I don't think silver's going back to 70. It might. I think 72 will hold. It could go a little lower than that. I don't think it'll go much below 65, but anything below 70 will be short-lived. Not so much for the stock market, but gold and silver will bounce. Those guys, you can only push them down so far. Then you'll get a decoupling. I've been waiting. That's the final battle I've been waiting for, is for the stock market to roll over, the onset of a recession, and then gold and silver, they go higher because the fear trade kicks in. So what happens is, initially when you get sell-offs in the stock market, for some reason, people don't run to gold as a hedge. They should, but they don't. Historically, they never do. And so, this was kind of my, argument with Michael Oliver. Other than that, I kind of agree with him. He's always said, don't worry about gold and silver going down. Don't worry about the miners going down. Well, we keep seeing the miners go down.
Silver's 33% decline masks an overbought correction rather than structural weakness. As Don Durrett points out here, gold and silver are poised to decouple from stock sell-offs once the market rolls over into a recession, exposing a recurring investor oversight. Metals are underutilized as fear hedges. Despite a 5% S&P drop and gold off 10%, long-term positioning remains intact, emphasizing strategic patience. Investors ignoring these cycles risk chasing false bottoms. Next, Don Durrett unravels how the final battle sets up the next leg for metals.
The miners are down 17% right now. So I've always been warning people, until we win that final battle, until we get to decoupling, expect downdrafts, expect deep corrections. And I've said anywhere from 20 to 30%, 15 to 30%. In the miners. So now, yeah, we're down 17. Expect, we could easily, I don't think you'll go down more than 30% in the deepest correction. I think we went down almost that much in October, and then we ripped back 4 to 6 weeks later. That correction completely reverted. And so we will see, these corrections with the stock market. Now, the key here is this the last? Is this it for the stock market? Is this the end? Is this the rollover? Is this where it just slowly, now we get higher lows? Is this a higher low scenario? I think quite possibly it is, but maybe not. I've always thought going into this year, there's going to be a second half. The stock market and the economy's real problems is the second half of the year. And the reason why is because Trump's going to run out of, basically mojo by July because of the lame duck coming up. So if he can't get he can only, like the Clarity Act, for instance, he's got to get that Clarity Act passed before July. Because once you get to June, once you get to August, they do the August recess.
Minor sell-offs hide structural leverage, not failure. As Don Durrett points out here, a 17% decline is within expected deep corrections of 15 to 30%, reflecting routine volatility rather than a market crash. Historical trends, including the October rebound within 6 weeks, reinforce that the stock market's higher low signals may yet form before any lasting decoupling. Investors must recognize the political calendar and legislative constraints on spending as hidden catalysts for market uncertainty. Next, Don Durrett discusses how these dynamics interact with metal portfolios.
They come back from that recess, you're not going to get anything passed for the election. So he has very little time now to get anything passed. And then tariff laws, if he wants to implement any new tariff laws, he's got to get that done before August. So tariff laws and the Clarity Act, I think the time collection. The other thing he's got to get passed before August is a new budget. And he wants to increase defense spending. Good luck with that. He said he wants to have $1.5 trillion defense budget. Good luck with that, right? Where are you going to get $500 billion? You're going to increase the deficit to 2.5? Where are you going to cut $500 billion? I mean, I thought that was hilarious. I mean, it's almost comical. There's no way in hell they're going to get a $1.5 trillion defense budget. I think the reason why he did the 1.5 is he doesn't want it cut, right? He wants an increase. 1.1, 1.2. I think 1.2 is about as high as he can go, but I don't even think he can get 1.2. So he's trying to get an increase, 1.1. I think it'll be somewhere between 1.1 and 1.2 is my expectation. He's starting at 1.5, but he wants to increase the defense budget. We really don't have the money, so that, deficit's coming.
Moving forward here.
Ambitious defense and tariff agendas face hard limits well before election cycles. As Don Durrett points out here, proposals for a $1.5 trillion defense budget are unrealistic, constrained by the August recess and rising deficits. Investors should consider how these fiscal bottlenecks impact liquidity, interest rates, and sector exposure, especially for defense and industrial stocks. The real story is how political timing intersects with economic reality, quietly pressuring markets. Next, Don Durrett talks about the cascading effects of these budget and tariff constraints on investment strategy.
Then when you're looking at the stocks versus the metal, you mentioned how the mining stocks are still undervalued. Do you mean undervalued relative to the price of gold and silver?
Yes, and the margins. So it's more the margins than the price of gold and silver. The key for valuations on gold and silver mining stock is the free cash flow multiple. So that's basically correlated to most stocks. They use PEs, but PEs don't work as well as free cash flow in the mining business because it's a cash business. You need cash to do exploration, do sustaining capex, to buy mines, to build mines. It's a cash business. You're constantly, burning cash. You're trying to build cash, but balance sheets are really important in the mining business, and so free cash flow is what I look at. So I use the free cash flow multiples. So right now they're ridiculously low, and the reason why they're ridiculously low is because gold and silver prices have blasted off. We had low oil prices, so we had low cost. You have these massive margins, anywhere from $2,200 to $3,000, depending on a company's cost structure. But the average is around $2,500 right now. That's pretty massive. I just did Newmont. They were $2,700.
Mining stocks' valuations are wildly misread because Wall Street ignores free cash flow multiples. As Don Durrett points out here, the focus should be on cash generation and margins rather than PE ratios, with miners like New Newmont generating $2,700 per ounce in margins, well above the average $2,500. This cash-centric view highlights hidden leverage and undervaluation, as metals prices surge but multiples remain low. Investors missing these metrics risk underestimating upside. Next, Don Durrett shows how these free cash flow dynamics translate into actionable returns and balance sheet strength.
So 2,700 times 5.3 million, it's $14 billion in free cash flow annually. And their debt is like $5 billion. So they can pay off all their debt this year. And they have like $5 billion in cash on the balance sheet, which they don't need. I mean, they could take their cash down to $2 billion, which would be fine. So they're going to end up with, they could pay off all their debt and still have, 3 or 4 billion cash on their balance, more than that on the year's end. So Newmont's going to be able to pay out high dividends, and they're low right now, and do buybacks, share buybacks, and then have a beautiful balance sheet by the end of this year. And they're trading at a 9 multiple. It's ridiculous. They should be trading an 18 multiple at these margins. For me, I've been doing this for 20 years. For a very high quality major like Newmont, a fair free cash flow multiple is about 15. If their margins were about, say, 2,000, that would be a fair multiple at 2,000 margins. But they have $2,700 margins, so they should be getting higher than the fair value. So the average and it's not just, I use Newmont because they're the largest one.
New Newmont's balance sheet strength exposes a Wall Street mispricing that few notice. As Don Durrett points out here, $14 billion in free cash flow against $5 billion debt allows for complete deleveraging while funding dividends and buybacks, yet the stock trades at a 9 multiple, half of what a $2,700 margin warrants. This disconnect highlights systemic undervaluation across high-quality miners, emphasizing the importance of cash over headline prices. Next, Don Durrett discusses why multiples remain suppressed despite such robust fundamentals.
But it's the same for all of them. They're all crazy. The average free cash flow multiple right now is about 7 to 8. And the reason why is because a lot of these miners, like in Africa or South America, Central America, they don't get a multiple of 10. A lot of them get 2, 3, 4, 5. They get low, really, really low multiples. And their forward multiples are even lower, which is kind of insane if they have any growth. And so right now the multiples like 7 and 8, it should be 14, 15. So they're all trading unbelievably cheap. It's the same with the silver miners. And so, yeah, the leverage right now is absolutely astounding because Wall Street does not believe that these prices are going to stay here. I mean, there was a poll, what bubbles are we in? And both gold and silver made the poll. I mean, I forget the percentages, but like 30 or 40% said that, yeah, gold and silver are both in a bubble. which is a joke. I mean, gold and silver, not even close to a bubble. Not even close, in my opinion. Gold, the chances of gold not trending to $7,000 or higher is probably less than 20%. So Wall Street's got their percentages out of whack. They're ignoring the gold miners. They're ignoring gold. They're ignoring the trends. They're ignoring the fires that are burning around their house. And yeah, these stocks are unbelievably cheap. Check out my article I just posted on Seeking Alpha. So it was basically silver producers that are, I forget, undervalued future production. I listed 18 stocks with significant leverage if silver goes to 150 and stays there for at least 2 years.
Miners' multiples are shockingly suppressed despite growth and leverage. As Don Durrett points out here, the average free cash flow multiple hovers at 7 to 8 when it should be 14 to 15, reflecting institutional disbelief in sustained metals prices. Polls labeling gold and silver bubbles ignore real production and margin expansion, misaligning perception with reality. This mispricing offers asymmetric upside if metals trend higher. Next, Don Durrett discusses which undervalued silver producers carry the most leverage for investors to exploit.
I always say that there was basically 4 battles, and we've won the first 3. So the first battle was in February of 24 when gold was at $2,000, $2,050, and gold basically ripped higher in March, April of 24, and gold broke out. And that breakout was very apparent to me. I turned uber bullish in the first week of April. And since then, gold went up $3,500 in 2 years, which is kind of insane, right? And now it's corrected back twice. Actually, it's corrected 3 times. Corrected in October. I think it was a 12% correction. And then it corrected again in January. And that was even, I think it was an 18% correction. And we didn't go all the way back, but we recovered quite a bit. And now we're down again 10% off the highs. We've had basically 3 corrections from that breakout. So that was, okay, so battle number 1 was in February, where gold won that battle. Second battle was in August when silver broke out. So silver was at $35 in August, and it went all the way to $120 in January, and now we've corrected 33% off the high. Quite a correction there.
Gold and silver's historic breakout highs repeated testing of investor conviction. As Don Durrett points out here, gold surged $3,500 over 2 years after February 2024, weathering 3 corrections of 10 to 18%, while silver rocketed from $35 to $120 before a 33% retracement. These patterns reveal resilience in precious metals despite headline noise and market skepticism, signaling strategic patience is rewarded. Investors should recognize corrections as natural consolidation, not failures. Next, Don Durrett unravels how these breakout patterns inform timing for future entries and risk management.
And so that was that, but silver won that battle. When silver broke out in August, that was correlated to the breakout in February of 24 for gold. They were both substantial breakouts. So it took silver 18 months, which is kind of crazy. It took 1.5 years for silver to confirm that gold breakout and say, okay, I'm ready to go with you. And so that was the beginning, in my opinion, of this bull market for the mining stocks. So the mining stocks were also, because silver and gold are so correlated, without silver, the silver miners, because most of the gold miners also produce silver. So until silver joined the party, the HUI, which is the miners index, couldn't really join the party either. And that was battle number 3. And HUI broke out. So the HUI was kind of stuck at 350. When it broke up above 350, 375 in there, it ripped all the way to 975. And now it's corrected 17% back to 806. The breakout, it went from 350 in the summer all the way to 700. So it went up 100% in that short period of time. And so it ended January 1st, it was at 700. Then it went all the way to 975. And now it's corrected back to 800.
Silver's delayed breakout reveals how correlations mask early gains in mining stocks. As Don Durrett points out here, silver took 18 months to confirm gold's February 2024 breakout. And until it did, the HUI index was constrained around 350. Once silver joined, miners surged to 975 before a 17% correction to 806, illustrating how index performance often lags underlying commodity momentum. Investors ignoring this delayed alignment risk missing asymmetric upside. Next, Don Durrett unravels how minor correlations and breakout timing shape portfolio strategy for sustained bull markets.
Now, this bull market is in place. It's real. It's going to have legs. I would say at least 2 years, but we're waiting for that final battle. So gold won its battle, silver won its battle, and then the mining stocks, the HUI won its battle, 350 to 900. These are not tops. They're not even close to tops. The reason why we know they're not close to tops is because we haven't seen the price action you see the top. For instance, the mining stocks, none of the mining stocks haven't even got pricey yet. You don't see that. I mean, they're cheap. You don't end a bull market, you don't start a bull market and end a bull market with the miners being cheap. I published an article today on Seeking Alpha with 18 silver mining stocks that I think all basically have, huge, upside potential. Not small, but literally huge. And I actually threw a couple of charts in there to show the kind of leverage that these things have at 150 silver, which I think where we're going. Now, where I'm leading up to here is the Iran war. So we have seen since 2020, and you can go all the way back to 2008 to 2020, manipulation of the markets where the Fed is basically not allowed the free market to work, taking interest rates to zero when we're growing.
Bull markets can thrive under manipulated interest rates without real risk to investor timing. As Don Durrett points out here, gold, silver, and miners have won sequential battles, yet prices remain cheap, signaling continuation rather than a top. Market distortions from zero-rate policies and systemic intervention since 2008 obscure the real signal of leverage and exposure. Investors must watch geopolitical catalysts like the Iran war that could amplify upside or risk. Next, Don Durrett discusses how this external shock interacts with ongoing bull market dynamics and positioning.
It's basically voodoo economics all over again, where Reagan was basically using, debt and leverage to supercharge the economy in the 80s. And, Bernanke and Yellen were both using low interest rates to supercharge the economy when it was growing. It's kind of the same type of situation. And we know where this leads. Some people will say, well, we can just kick the can forever. Janet Yellen said, we're never going to have another financial crisis in my lifetime. This so-called, this idea with modern monetary theory that we can just use liquidity. We just print what we need. And as long as we have enough liquidity, the only thing that causes recessions is a lack of liquidity, is kind of the mindset. But if you pay attention to the old guys, Jim Rogers says, if you think that, the business cycle went away, I got news for you, right? The older guys, Warren Buffett, he's all in cash. Jeremy Grantham, the king of the bubble, says that this is the worst bubble he's ever seen. The bad stuff's coming. The Iran war, so we know the economy's slowing, right?
Mainstream narratives ignore generational warnings and bubble signals. As Don Durrett points out here, historical patterns from Reagan era leveraged to post-2008 low rates show that artificial liquidity temporarily masks economic decay, while respected investors like Jim Rogers and Warren Buffett signal caution. Modern monetary theory and endless interventions cannot erase cycles, leaving portfolios exposed to systemic risk. A slowing economy and widespread mispricing suggest the bad stuff is imminent. Next, Don Durrett talks about which early warning indicators investors should monitor to navigate the coming slowdown.
We look at the jobs data. The jobs data since June of last year has steadily been weakening. They just revised a loss of 700,000 jobs over the last, 7, 8 months or something. They revised them down minus 700,000. And then last month it was minus 90. And now they're going to rise it probably lower. So it's probably minus 125. So the jobs market has been weakening. The housing market is, recessionary area, right? We have the 10-year note out of Iran jump from 4. It was actually sub 4. If you look at the chart, in January, the 10-year was sub 4%. Today, it's a 4.2 on the back of a crisis. That's not supposed to happen. So you have to ask yourself, why is the 10-year going up in a crisis? The reason it's going up is because of oil prices creating inflation. Inflation's bad for the 10-year, bad for the long bond. The long bonds have been going up. That's bad for housing. Now, can they get that genie back in the bottle? Can they get that 10-year back down? Can they get it to 3.5? Well, 3.5 even helped the housing market. They probably got to go all the way to 3, right? So the Iran war is basically kind of a one more kind of jab to the U.S. economy, which has been weakening. I've been saying, going into this year, I basically said that this year, 2026, is when it all happens. I'm calling this year the last year of American greatness because we're going to lose our economy, we're going to lose our growth, and we're going to lose our bond market. So all the bad news is coming, and the Iran war is very likely the trigger to all that. But we didn't need that trigger.
Rising bond yields during crises reveal inflation pressures Wall Street pretends not to see. As Don Durrett points out here, the jobs market has been weakening with revised losses of 700,000 over 8 months, while the 10-year Treasury has jumped to 4.2%, driven by oil-related inflation, signaling stress in housing and broader economy. The Iran war is a catalyst, not the root problem, with systemic declines expected in growth and bonds.